We're back in action.
We're back in action.
It's great to be back. Today we're going to talk about something that's been coming up a lot, which is seller financing to buy a property.
Correct.
Seller carry, seller finance, creative finance. What does it mean and why is it so important to understand it as an investor?
With interest rates going up the way they are, and with the banking industry being a little shaky because of all these, I'm going to call them bailouts for lack of a better word.
Mergers, bailouts, sales.
Yeah, there's a lot of mergers happening now, and there's a lot of speculation of who's going to be the next bank.
Yeah.
And I don't know if it was before Congress. I'm not sure. But there was a panel. It may not be before Congress, but there was a panel, and somebody was asking someone in the banking industry, hey, is every single bank now going to be bailed out by the, FDIC? Because
by the federal government.
Yeah, by the federal government. So everybody that, it's on the verge of collapse or whatever, or has been making bad, quote unquote, investment decisions. See, the problem is the interest rates going up on these interim loans, and then it kills.
Well, banks haven't obviously learned their lesson from 2008, 9, and 7, 8. And so you got to get creative. And that's why these deals and seller financing is really interesting.
Well,
because
seller financing is fantastic.
Because all that stuff you're mentioning about the banks is real, and it's going to continue to go down. And so people want to get the way I look at it is people want to get their money out of the bank and into something, an investment, apartments, commercial buildings, whatever it is, that will give them a return, that will give them some sort of appreciation or get into a real asset. Because imagine you have, you've saved up your life for 30 years worth of money, and you've got it in the bank, and you're not sure if it's a safe.
Right. Well, you're young. I'm in my 60s. So your friends have a tendency to be younger. My friends have a tendency to be older. And from the older perspective, people that are in their 60s, there's a lot of people scared about the money that they have in their 401ks, There's a lot of people scared of the money that they have in their CDs. This is the perspective from the older crowd.
Yeah.
There's a lot of instability out there, and it's been created because we're bailing out these huge amounts of monies from these two banks, and now there's more. There's a Geneva bank now that
there was a Swiss bank.
A Swiss
bank.
Okay.
Yeah.
So there's a lot of people out there second guessing themselves and somewhat afraid. That's why seller finance is a very important aspect of buying and selling property today.
Because it leaves the bank out of the conversation.
Correct. The seller becomes, quote unquote, the bank in this transaction. And as the bank, they dictate the interest rate, which is usually much lower than the prevailing rate. And the reason for that is because, you don't take a hit on capital gains depending on your quote unquote down payment, and you pay taxes as you go along. So along with that, you create what's called an installment sale.
Yeah.
Okay.
Well, the capital gains and all that, obviously people need to check with their tax people.
Absolutely, guys.
But you're able
ladies.
you're able to defer or maybe minimize some of the capital gains tax that's owed because you're taking it in installments. So the only way for seller financing to work is you have to have a property that's paid off.
Yes.
If they're gonna finance, unless you cover that first lien or that first loan.
So the property, but in a lot of these cases, the property is fully paid for.
That's the cleanest way. So let's explain that one.
Well, however, even it can work if you owe a little bit on the property.
Yeah.
Okay. The person that's buying can come in with that, clear that note, and then have the seller carry.
Got it.
So
Got
it
it.
doesn't per se have to be completely paid off.
But for, let's say, this example,
Yes.
or to make it clean, let's say they have a property paid off.
Yes.
They've had it paid off. They've owned it for 40, 50 years.
Yes.
Let's call it a commercial building,
Okay.
and it could have units. It could be retail, multiple units, for example.
Okay.
So why would a seller want to carry a loan? Why would they want to create a loan on that when it's paid off, when they could just have somebody pay them cash or go through a bank and then get all the lump sum at once? Why
Okay.
would they do a seller carry?
Okay. Well, we have one right now
Yeah.
where the seller is more than happy to carry the paper because if he doesn't and he takes that lump sum, potentially, depending on where he stands with other forms of revenue in his life, he could lose up to 55%, 50% of the sale. If you get $1 million, $500,000 is going to go out the door.
Case by case, but
Case by
the
case.
reason he wants to do a seller carry is because he wants to pay less taxes.
Correct.
Legally.
And he's looking at the property as an annuity. In other words, he's going to go 10 years receiving installments, and at the end of 10 years, there's going to be a lump sum payment. Okay? Now, he's an older gentleman in our case right now.
Yeah.
So what he's saying is, look, who knows if I'm going to be around? Nobody knows at any age if they're going to be around tomorrow. But he's an older gentleman.
Right.
And he's saying, if I'm not around, then the lump sum goes to the estate. Okay? However, the other thing that's beautiful about this thing is that prior to the lump sum, you can get together with the payer, okay, the one that took the new note, and say, hey, do you want to extend it? So if the seller wants to extend it, it can be renegotiated. And I have nothing against banks. I've used banks a lot in my lifetime. But you don't have to go through this strenuous underwriting that potentially may exist in the banks. Especially commercial is a little different monster than residential.
When you say underwriting, you're talking about tax returns. You need to show financials. You need to show, all the things that a bank asks for to get that loan. And also that you have to come up with a down payment.
Yeah.
That's typically on a commercial building.
30%.
Yeah, 30, 40%, let's say.
Right. Now, having said that, on seller financing, that could be one of the drawbacks for the seller because you want to make sure that the person that's buying the building is capable.
Right.
Because the last thing you want to do is have to foreclose on that person. Okay? So you need to measure the risks involved and you need to get a decent down payment, okay? And check credit reports on these people. Make sure that they have funds available to do this.
Right.
That they have a healthy...
You don't just want to lend it. You don't just want to lend to anyone.
Blindly, no.
So,
but I guarantee you it's not going to be as strenuous as
sure.
with a lender, especially now that the system is so shaky. I guarantee you that things are going to get tightened up again,
Yeah, and I've noticed that in like commercial deals or apartment buildings, seller carry seems to be something that's somewhat common because it might be hard to finance that property. They know that the new buyer, whoever the buyer is going to have a hard time financing it. So they're like, it's okay, I'll finance it. Or the situation you're talking about, they're trying to reduce their capital gains taxes or other taxes. Or they just want to create some sort of income without having the headache of the property.
Right.
Or property taxes.
Or property management.
Maintenance.
Yeah, management.
So there's a lot of...
Yeah, go ahead.
Well, there's a lot of interesting reasons why a seller would want to do it. The people we've come across that have wanted to do it tend to be older people who are tired of managing property. So, because you could say, well, and we've been asked, like, why would a seller want to carry a loan? And so you explain those things. But uh, the other option that a seller could do is do a 1031 exchange.
Right. But that means you're buying another property.
Right.
And in the 1031 exchange, you have to scale up a little bit.
And you
Okay.
have time, you have
Time constraint,
timelines. Yeah.
timelines, yeah.
Which some
Which,
people don't want that. And
no, it's a
it's,
headache.
yeah,
It's,
we know some investors that had a real hard time stressing out.
well, I mean, I've done it. And if you get to the end of the 45-day period for identification, you're cutting it short. And now you're facing a huge tax consequence potentially,
Yeah.
you know. And
But
so, but the seller finance can be, it's extremely flexible. I've used it many times. And I do what's called an installment sale. So it's a win-win situation for buyer and seller because I can schedule a payment, you know, not necessarily on the year of purchase. Okay?
yeah.
I can schedule it after the first of the year, let's say, and then that gives the seller an additional amount of time to do something with that, and
Right.
that would be a scheduled installment payment on this purchase. It is the easiest thing in the world, and it helps both people.
Yeah.
The seller um, is the one that's at most risk because you need to make sure that you find a buyer that is worthy economically to make good with what you've got. But there are many ways of putting it together to help both people.
Well, I want to talk a little bit about some of the deals you've done because you've done seller financing for many years now.
Right.
You've bought that way, but we don't want to over glorify how seller financing because we also know some people that did seller financing
And got in
and
trouble.
they got caught with the bag. What's it called? Like the person couldn't pay back,
Correct.
so
So they have to
they
foreclose.
had to take over either the business or the property
It's a
back.
pain in the neck.
So there are issues. It's not like it's a
No.
perfect thing.
No.
So we want to cover both. But,
I like it a lot,
well,
but it's because it's worked for me.
right. And one of the things I think that is really cool about it is you can negotiate. So, for example, you said you can delay the first installment
Not
or the down payment.
You can, no, you give a down payment
Okay.
and you can schedule another payment later on down the line.
Later on, that helps the seller more because it's in the following calendar year.
In the
tax year.
following calendar year, which doesn't put, and by the way, none of this is perfectly legal, okay?
Yeah.
This
No,
is all up and up, and I mean, you can schedule payments, and they're called installment payments.
yeah.
You can even put some of the money in a so-called escrow account if the seller's worried about something. But if the seller's worrying about something, maybe they shouldn't do the deal. So yeah, you're right. We should not, you're absolutely right. We should not glorify
Yeah.
seller financing because, it can go south. There's risk in everything.
There's risk in everything,
In
and I
everything.
think you just have to. I think what it is, and the reason we're doing this because it's interesting to us. We like those types of deals, whether it's it for us or somebody that we know that's an investor. We like those deals, and we're looking for those deals. But the thing is, we know how to explain it to people, and not that we're the experts in it either, but you have done it before.
I've done a few, yeah.
So
a few.
when you can explain it, that's why we're doing this. It's just to share because it's come up quite a bit and we've been asked, and people that are in the investment world, some of them are not familiar with it.
No, and I was very surprised, just as you were, because I had a couple of people that are in real estate, and they said, well, what happens to, well, let me rephrase that. They have a real estate license, but they're not active in real estate. But they still have a real estate license. And they've asked me, well, what happens with the title? Well, title gets transferred.
Right.
And so they didn't know this, which...
So let's explain it. So you're either dealing directly with an owner or through an agent or whatever the case.
with an owner, most likely.
You could be dealing directly with an owner. But
With the
no, in
owner.
some cases it's with an agent, like one of the deals that we have right now. So let's say you're really dealing either way,
Either way.
and you come to an agreement on the terms, which I want to say what's really cool about that is you can negotiate the terms. You go to a bank and they say, hey, what's your credit? What's your state? Give us your profit and loss or whatever. Give us your returns. Here's your debt to income ratio. This is the interest rate based on what the rates are right now. With seller finance, you can actually negotiate the rate.
You can.
You can. You can
Yes.
say, hey, you know what? The numbers make more sense at this rate or that rate. So I think that's pretty cool. Anyways, the you open escrow, you create a note, right? And again, every state might be different. We're just speaking from our experience in it. You create a note where the seller is asking for a certain amount down payment, and then they're gonna carry a note, a paper, first note in first position, deed of trust.
Yeah, so the property is the collateral.
And the property is the collateral. And then the payments are made to the buyer, the new owner will make payments to the seller.
Right.
Of the property.
Right.
Until that balloon payment comes or whatever terms they agree on.
Right. And the beauty with...
but real quick, title transfers
of course.
to the new owner.
Of course.
However, there's a lien on the property.
Yeah, the property is it's
got a loan.
It gets recorded because the property is collateral. But the beauty of it is that, okay, so, I always say, the good Lord gave us 2 ears and 1 mouth, okay? We should hear double of what we speak, right?
Yeah.
So, and that's extremely difficult for me to do, okay? It's extremely difficult for me to do.
Yeah.
But if we listen
Yeah.
to the seller, then we can formulate a plan that benefits both of them.
Right.
Because you said, okay, you can negotiate the rate. Some folks are not necessarily too interested in a super high rate. Okay? What they want is a constant flow of income. Because we're talking usually to older folks, usually they have the property paid off, okay, and don't want to mess around with tenants anymore. They're up to here with tenant problems, like...
Or maintenance.
Maintenance, I just had, a bathroom leak and...
A plumbing issue.
I thought it was going to be $80 and it ended up being substantially higher than that, okay, because there were more issues. And I had to deal with it. So some people are just tired of dealing with maintenance issues. The electricity goes off, a lamp goes off, leaky roofs, and on and on and on.
Yeah.
And so, the interest rate might not be all that important. It is to some, but what they want to do is, look, I just want to get rid of it.
Yeah.
I don't want to have any more headaches. I want to relax and travel. That's what the guy told me. I just want to travel with my wife.
Yeah.
Okay? So I want a steady income. And there, potentially, you can negotiate 2-3 percentage points.
You can negotiate the down payment.
The down payment.
All of it is negotiable because the bank is the person selling it to you.
Right. So what happens is, as long as you're coming from a good place,
Yeah.
okay, you want it to be a win-win situation,
Definitely.
okay?
Yeah.
And some people are willing to take a little less for the security of consistency,
Yeah.
that they can trust the man or the woman that's coming to buy it.
Yeah.
Your word is gold. And you say, hey, this is the way I'm going to perform.
Yeah.
This is what I'm going to do. And of course, you can be careful about it by creating scheduled payments down the line. Okay? I mean, I've done it. One time we ended up buying an agency, an insurance agency, and the owner was scheduled to receive a payment the following year, but towards the end of the following year, like after June. And something happened, and they needed it, earlier. And they came to us and we renegotiated things and we were able to do it a little bit earlier, because you have that flexibility as long as buyer and seller are capable.
Right.
Because, for example, if the money's not there and you still need it, there won't be a possibility of renegotiating that payment sooner. But with seller finance, you're a little bit more flexible, okay? And so, those things happen. I've actually lived them, and, you say seller finance. So, for example, there was another agency that we were purchasing.
So what's cool is that you can do seller finance with anything.
With
it
anything.
Could be a property.
Yes.
Which we're big believers in buying property that way if you can.
Yes.
But it could also be an insurance agency, a
Yes.
business.
Yes.
It could be a vehicle. It could be whatever.
Yes.
Anything that it essentially has no debt, or you clear the debt it has with some sort of down payment, and then the seller is willing to take installments, say.
Yes.
Installments for the purchase.
Yes.
For the sale, I'm sorry.
So, for example, I've been in the insurance business forever. I went from being a captive agent to an independent agent. And once I entered the independent world, they treated me like a brand new agent. All those years that I worked as a captive agent meant nothing. So when it came to a seller, I had no strength, no ability to show.
You hadn't proven yourself in the independent world.
No.
As a broker.
So in order to get in there, okay, instead of financing the book on its own, I was able to say, okay, well, look, if you don't think that I can handle it, I have this property, okay, upon which we can, write a note against as additional security to you.
Mm-hmm.
Not just the business or the book of business, but in addition. And so that changed the playing field for me.
Right.
As, a new person, in some people's eyes, not knowing anything. And to a certain extent, they were somewhat correct because they're two different worlds. Okay? And a lot of experience in one does not necessarily guarantee performance or success
so
in the other one.
Putting instead of the loan being secured by the business that you were buying, so the seller instead was able to secure that loan
with
that
property,
he was carrying with a property that you owned,
which they liked it better.
Yeah.
And by doing that, they over-satisfied themselves.
Yeah.
Because there's very few people out there that are able to do something like that. And the property was not a big deal. It was a small property. But it gave him a tremendous amount of peace of mind because that was like gravy.
Well, from the seller's perspective, property is going to be there. The business, you could run it to the ground.
Right.
So it's a risk. What if you run it to the ground,
right,
or the insurance carriers make changes?
Right.
You still owe him that money. How are you going to pay him back? Now you're saying, I would have to sell the property, but I can pay you back. Or,
right.
Or cash it out, refinance.
Right.
So, yeah.
Things happen always, Mike.
Yeah.
Because not only, ladies and gentlemen, there are risks in everything that you do in life. And when you get creative, then you get exposed to other forms of risk.
Right.
What happened to me in one of these purchases is that by the time we were almost done with the payment structure, it was difficult to find the seller to reconvey the note and cleared my property.
Reconvey would mean just
so because it's been
to show
paid.
that it's been paid off.
Right.
Clear that note off of your property.
Right. And fortunately, I had a great relationship with one of the sellers, and we were able to resolve the issue. But you can get into these issues.
Yeah.
Okay. And without getting too complicated, you can do a note and have an intermediary hold it. It's like a reconveyance doc. So I don't want to get too complicated, but
Yeah.
there are risks in everything.
Yeah.
And even though I thought I had done everything properly, then at the end of the day, you've paid off this thing and you can't find the person to reconvey the note to clear the property. You got an issue.
Yeah.
Fortunately, we were able to do it. And there are steps that you can take to avoid these issues, okay? But
Yeah. I think one of the big things is the seller having trust in the buyer, because, like, for example, another deal that we've come across, or that we know a gentleman that was structuring this deal. They were selling a property to the tenant that occupied that property.
right,
Was renting it for 17 years. It was a single family home. The tenant always wanted to buy that house, always wanted to buy it, and the seller had a relationship, the landlord had a relationship with the tenant. And when it came time to sell, the tenant said, I'll do it. And the seller said, since it's paid off, I'll finance it. And so now, instead of collecting monthly rent, the seller of the property is collecting monthly installments on the loan.
monthly installments, which he's happy with. And in this particular case,
Yeah.
they had a relationship. They weren't family, but
Yeah.
they got to know each other. And what I'm getting at is this seller took $100,000 less than what that property is worth in the market today. And he felt absolutely fantastic to be able to help that family.
Yeah. Yeah.
They
Absolutely.
lived in that house for 17 years. They called it their own home.
They took care of it. And that's the thing, is that you are able to, if you build relationships, situations, deals like these can happen.
And this gentleman is the seller is very successful. He's he's quite up there in age, and he was very happy to do this
Yeah.
for
Yeah.
these people.
Yeah, I give a lot of credit to Pace Morby.
Pace Morby.
Who has his YouTube channel, and he's an investor, and he's all about creative financing. Now, when you get into creative financing, this is like saying medicine. The practice of medicine, right? You have specialists, you have cardiologists, you have endocrinologists, you have ophthalmologists, all these different specialties. So creative financing includes all of them. But in his channel, which we'll link on the description, he shares a lot about seller financing and seller carry. But he also gets into other stuff like subject to,
Yeah.
and taking over mortgages, which we won't get into that on this one, because it's different than seller carry.
See, that's scary to me.
Yeah, that's a different, but
Subject to.
But he does.
But he does it all the time. Yeah, this is the guy with the beard.
Yeah.
Yeah. Okay.
Yeah,
I know who you're talking about.
But he does a lot about seller carry, and I remember him structuring one deal that he has it on his YouTube channel, which is crazy. The way that this went down, he was buying a single family home, and he was gonna rent it out, but it needed to be fixed up and a few things, and the person was living there. So what he did was he said, "Okay, I'll buy the house from you. I'll give you a down payment in 6 months, and then I'll give you the second installment of the down payment in another 6 months." And then what he did was, after rehabbing it and fixing it up, he rented it, and with the rents, it was giving him a positive cash flow. He was able to give the first down payment based on the positive cash flow. He accumulated enough to put this first, I think it was like $6,000 down payment, 6 months into it. And then with the other rents, he accumulated it. So he had zero out of pocket.
Well, see, that's as creative as it can get.
Super creative.
And so, without knowing anything about this deal, okay, why would the seller do that? Maybe, okay, so the property needed to be rehabbed. Maybe the seller didn't have money to rehab the property. You see? Or maybe the seller, you just don't know
Yeah.
what's important to certain folks.
Yeah,
It all
maybe.
depends on what's happening in their life.
Well, we've had
Truly.
some people that want to move out of state.
Yeah.
They just want to sell.
Yeah.
They want to move out of the country. We know. I mean, yeah. Who knows? A loss in the family, unfortunately.
Retirement. We're
Retirement.
gonna
There.
meet this week with someone that's retired,
Yep.
and they sold their medical practice, and now they got a couple of places that they're saying I have no use for them.
Right.
What am I gonna do? And they're not really interested in managing properties nor people because
Yeah.
so
I mean,
they're retired. They want to just chill. They've been working really, really hard all their life
and
in
you
the
have
medical profession.
yeah, and you have some people that they say my kids are already set. You know, like they have their own businesses or they're doing well, great careers. They don't need the money or whatever the case. They don't want the property. They'll sell it anyway. So yeah, it you don't know unless you listen, like you said, what are the motives and why somebody, and then all you have to do is figure out and not take advantage. That's the
No,
big thing is you have to figure out how to make a win-win situation,
right.
because I think with seller financing you could also take advantage if you're of somebody, and that's not a good thing.
No,
you know
it's if you take advantage of people, sooner or later, it's gonna come back and bite you, and really hard.
yeah,
Um,
it'll come around.
yeah, it's not the right thing to do, folks, and so don't do it. Just be fair to people. But some
Yeah,
people's motivations are different. Like, look at this guy took $100,000 less,
right.
okay, than what the property is truly worth, because he had a relationship with these people and he felt good doing that.
Yeah.
And at this point in his life, he doesn't need the 100,000.
Yeah, that's a good point, because one could, from the outside, without hearing that story, one could say he sold it for
They took advantage
they
of
took
it.
advantage. They bought it for 100,000 less.
But he's super happy. We've talked to this man about it, and he says, I feel such a uh, good place in my heart that I was able to help these folks move or stay in that property after all those years.
Yeah.
He's so happy about having been able to help. You know, the truth is that it's always better to give than to receive. You get this euphoria, from giving and helping people because you feel good about it.
Yeah.
It's better to give than receive, and he feels great about doing that. And the people that are in the property um, really truly appreciated this,
Yeah.
and that also is another form of him feeling great about it because he sees how much they appreciated it.
Yeah. An immigrant family,
An
he
immigrant
said, and they
family.
came and he gave them that opportunity.
Yeah.
And we've had different situations. We talked about it on a previous podcast where one of our buddies bought a business without any money. The seller of the business put 50 grand in his bank account so that he could qualify for a loan to buy the seller's business. So
Again, another relationship because this guy worked his
yeah, he worked for years.
back off, and the seller realized it, and he didn't have any kids that wanted the business.
Right.
And he said, you deserve this business. Well, I love to buy it, but I don't have any money. Oh, I'll put the original 50,000 in there, and then you can just give it back to me.
Can you imagine that?
Oh well, I mean,
But those situations happen if you're out there, I think, working, maybe planting seeds. Hey, one day I'd like to buy this, have this building, business, whatever. Being genuine with people and honest. And I think if you can maybe do those three things, people will notice you.
of course.
And you got to be a go-getter, but those deals are out there.
Yeah.
I remember one of my teachers, which is a friend, told me a story about his parents that came from Mexico. Humble. I don't think any formal education beyond a certain point, or no formal education. And they saved up and they were able to buy units, like five units. But then something happened where they were like warehouse. They worked in a warehouse and everything, very hard labor. But something happened where soon after buying those 5 units, which they saved up and took took everything from him. Another apartment building came for sale, and the real estate agent went back to them and said, "Hey, do you want to buy these now?" And I don't remember if it was another five. I don't remember right now. And they said, "Well, we just bought this one. We can't afford to buy another one." And but the mom, my teacher, my friend's mom, said, "But you know what? Tell them if they're willing to carry the loan, I'll buy them. I'll make payments of them." And the agent, apparently, according to my teacher, says that he told his mom, he told my teacher's mom, "You can't buy property like that. No, you can't do that. You know, that's not how it works." And that she said, "Well, the worst he'll say is no. That's fine." And she ended up buying that property too, because they took it to the seller, they liked them, and they ended up buying. So within, like, let's say 2 years, they bought like 10, 11 units, something along those lines, and then from there they kept buying. And but all she did was say, "Go back to your seller and just tell him I'll buy it if he's willing to carry the note." That's it.
That's it. Nice and simple.
And they struggled a lot with that deal, because many times they thought it was a wrong move, and that they shouldn't have bought it. They overstretched themselves. But now, looking back,
Oh,
I mean,
because that sounds like it happened a long time ago.
this happened, a long time ago.
Yeah.
Maybe 20 years or 30 years ago, something like that. But those deals are
can't go
out
wrong.
there. You just gotta try, right?
Oh, yeah. Just ask. And listen to the people that you're speaking to. Let them, you know how sometimes you're talking, I interrupt you a lot. Don't do that. Listen to the people. Don't interrupt them.
You know,
And see what their hot points are.
yeah,
You
yeah.
know?
Actually, listen.
Listen.
Don't just wait for somebody to stop talking before you know. You mentioned about, or we talked about this gentleman that gave the tenants that were 17 years in his property a chance to buy, right? You bought a business in the same fashion. You were the smaller guy,
Yes.
in comparison to a huge company that was buying businesses, agencies, and they had tons of money and funds and this and that, but the seller believed in
And
you
I didn't.
and wanted to give you a chance.
Right.
Yeah, I mean, in comparison, they were the huge corporation and you're an individual,
Yeah, there's no
and they gave you a chance.
compete. I mean, it's, yeah.
So, but because you built a relationship with the seller,
Correct.
and
Correct.
he liked you and he
And-
wanted to give you a shot,
Right. He took a chance. You know?
and you're friends to this day.
We're friends to this day.
So seller
Yeah.
financing can work, and it's the best way to buy property, or it's a great way to buy property.
It's a great way to buy.
and
Look,
businesses.
when interest rates are high like they are now, and the banking industry is a little shaky, seller finance is a tremendous option to exercise.
That's a great point.
Yeah, because when the interest rates were at 2%, 2.5%, 2.8%, 2.8%, 3%,
Yeah,
okay, I'll buy property and I'll let the bank finance it all day long,
right.
because you know those rates are going to come back up, and then you're going to have that, hopefully at a very low rate.
Now let's address one thing, like on this situation where you said the seller's buying. I mean, the seller is selling it. They're gonna finance it, and in 10 years, they want a balloon payment.
Right.
How do you deal with that?
It's all formulated in the note.
No, but
And
how do
all
you
scheduled out.
how do you pay that off?
Well, that's
Because-
the buyer's problem.
Right.
You-
But as a
hopefully-
buyer, how do you pay that off? Do you have to, over the next 10 years, figure out, like, start saving for the
Oh,
payoff, or do
10
you
years-
refinance it?
Yeah.
Do you
So
sell
the
it?
answer is 10 years gives you quite a bit of time to try to strategize. And hopefully in 10 years, the property you bought is worth more. So worst case scenario, you would be able to, God willing, refinance.
And pay off that balloon payment.
Pay off the balloon payment
Lump
and
sum.
have the new bank come in and carry a note and amortize that note.
Got it. Got it.
So that's, and you have to, you can do seller finance and have a note for 5 years. 10 years is a good stretch. So you have enough time to strategize. 5 years is pretty good too.
But they'll go fast.
5 years go fast. 2 years is very risky.
Yeah.
So if you're seller financing for 2 years, and at the end of the 2 years goes by in a blink of an eye.
Yeah.
So if those, if you're, yeah, if you're
If you
doing
can
a,
negotiate a longer payoff.
yeah, I would, because you don't know in the 2 year range what can happen. And you also, everything has a risk, because you could go 10 years and at the end of 10 years be in a downward cycle. You're not going to be able to refinance that. So you have to,
Yeah.
you see what I'm saying?
What
So
if-
it doesn't mean that in 10 years the property went up in value. If we hit a recession or whatever in 10 years and you get a slump and it might be on a downward, it might
Right.
be worth the same thing you paid for it 10 years before.
That's a great point.
But yeah, so you have to strategize. There's a risk in everything that we do. Even walking out the front door is risky. Okay? So, right? So,
Yeah. And the last couple of things, and unless you want to add anything else, we can wrap it up here.
okay.
On the payments, the monthly payments, you could, the seller who's structuring this seller finance could also say, I want interest only to keep a lower payment for the buyer, or I want principal and interest. The seller can also say, amortize those payments over 30 years,
Sure.
even though it's due and payable in 10.
Right. And that's what creates a balloon payment. That's what creates the.
Right. So
Yeah.
all of those things are what goes into it. And in our situation, we've seen it done through escrow or an attorney, where the payment, what would you call it? The note
The
and
schedule.
the payment, the
The
schedule,
schedule of payments.
that's set up through a escrow or an attorney.
You're right. Most likely, the seller will want potentially his attorney to double check it. A real estate attorney.
Now I have a question. In the insurance agency that you've bought, did you open escrow for that, or is that just direct without an escrow?
I didn't open an escrow on that.
Got it.
I use a law firm.
And just direct.
Yeah.
But you can open escrow for businesses as well.
You can, and I guess to put monies in a trust or have the escrow, the escrow is a neutral party. And so you can. We used a law firm.
Got
And
it.
this law firm, by the way, he had his own law firm, and I had my own. You can
I see.
yeah, you can do one of these purchases person to person, okay? And the initial approach is owner to owner. Then depending on the magnitude of the business,
The complexity
yeah.
of the loan.
yeah, because if it's a small agency and it's just a few payments, you don't need an escrow and you don't need a law firm.
Yeah.
Even though it's always recommended, right? For a second opinion. You get somebody to look at documents before you sign anything and you get yourself in trouble. And there are other things that go into play because, for example, you have to make sure that carriers are still providing the same appointments for the agents and so
Yeah.
forth. So it's a different monster, different vehicle. But yeah, in this particular one that we're talking about, because in others I didn't use a law firm. It was just between the two owners.
Got it.
But in this particular one, I had my law firm, and he had his own representation,
Got it.
and so we came together, and
It's interesting. It's creative,
oh, sure it is.
because a lot of people think, and you need a huge down payment, or you need, to get qualified with banks,
You
need
might,
2 years tax returns.
you might not,
need,
right?
but when you're dealing directly with the seller, you can get creative. So,
Yeah,
anyways, I hope that this maybe opened some clarified a few things. Maybe we confused more people than anything.
no, I think there's just a lot of help out there,
Yeah.
and there's a lot. YouTube, it's a marvelous thing.
It's a university.
Oh my God. And you can go in there. Now, you could have, what is it called? Paralysis by analysis.
Oh yeah.
You can try to analyze this thing to the hilt, and then you're never going to pull the trigger.
Yeah.
At some point, after putting in a lot of homework, and it's a scary
You
thing.
got to make a move.
Yeah, it's a scary thing, you know?
But making a move and putting some skin in the game and risking is really the way you learn the most, in my personal opinion,
It is.
because it will hurt if you make a wrong step.
Right. So, what a lot of people say is get a mentor,
Yeah.
somebody that's doing it.
Yeah, I mean,
And
YouTube has a lot of mentors, you can say.
Well, you need to be careful who you take advice from.
That's another thing. So, do you get a mentor or do you not?
Well, Grant Cardone says, you know, you have to be very careful who you take advice from. So you can consult a law firm that does, real estate, and
Look,
you can search it out on your own. You can, if you're
from my perspective. Sorry, go ahead.
No, go ahead. I'm done.
From my perspective, you just need to do it, and if you're able to talk with an owner of a business or a property, units, commercial, whatever, and build a relationship with them. And if you're able to talk to them about them carrying paper and being willing to finance the purchase for you to buy it, at that point, once you have that conversation and build that relationship, you can find a way to buy that, because there's a lot of people that are interested in buying property this way. So whether you buy it yourself or whether you partner with somebody, if you I think that, like, I tried with the units that I bought with a partner, I really tried for them to carry the note. And I said, give me a year, give me 2 years. It didn't work that time. Maybe I was green, I didn't have the experience that I have today. Or maybe he wasn't going to carry no matter what. But if I would have been able to have somebody if you can get somebody to carry and it's a good rate and it's a good purchase, it's a deal, you'll find a way to fund that deal. You'll find a way to partner with it. You can take it to somebody. You can assign, there's so many ways to make it. But if you build that relationship, I think that's the most important thing.
Oh, absolutely.
Yeah. Anyways.
All right.
We can wrap it up there.
All right.